Sri Srinivasa Devara, President FAPCCI, Mr. Shivkumar Gunta, Senior Vice President, and who is going to take over in the next year of the FAPCCI leadership, Mr. Rana, Vice President, Mr. Govind Prasad, Chairman Banking and Finance Insurance Committee, Mr. Balarao, the new Secretary General FAPCCI, my colleagues from the Reserve Bank of India, Dr. Krishnamohan and Mr. Das, and other members of the FAPCCI, and ladies and gentlemen who have assembled here. A very warm good evening to all of you. It really gives me a great pleasure, as Mr. Haidara mentioned in his opening remarks, for me to be in Hyderabad, as I have fond memories of Hyderabad, my working in the office of the Reserve Bank of India, my interaction with the people of the Andhra Pradesh, and specifically my interaction that those days I had with the FAPCCI members. So that's why when the request came, I could not refuse, and the first available opportunity I could come here. Thanks for the opportunity. Today I had selected a topic for interaction with you, which is more relevant to ordinary members of the public, which we are. All of us are primarily members of the public first, and then be an industrialist or members of FAPCCI and all. So the idea that impacts them, that's one I thought I should give some explanation about why we did certain things from the Reserve Bank of India, the rationale behind it, and the difficulties that the common persons faced and how we are addressing them. So then after finishing that, I will certainly react to certain ideas that have been proposed both by Mr. Ayadevara and Mr. Prasad. I'll be interacting with them. First is about the know your customer. Is it a recent phenomenon? Because this know your customer as a concept we have been talking about in the last few years only. But is it really a recent phenomenon? No, not at all. This is a concept the banking system had been practicing, not with that name as such, but the essence of the know your customer concept has been practiced by the bankers right from day one, when the bank itself started way back in 15th or 16th century itself. KYC was always there in banking. The focus earlier was more on the asset side and not on the liability side, as no banker could risk parting with his funds to an unknown person. So when a banker lends money to any party, whether it's an industrialist or a trade or business or even individual, unless he knows how far the money can come back to me, so that credit risk assessment, it's nothing but a know your customer assessment. The thorough appraisal process to screen the potential borrowers is a good example of a KYC process. Then issues such as illegal and or black money, and more recently terrorism financing, became matters of serious concern, and then KYC on payment side and remittances, and consequently on the liability side, started assuming greater importance. Sound KYC policies and procedures are critical for protecting the safety and soundness of banks and the integrity of the banking system in the country. Due to increasing globalization of Indian banks, their interaction with other countries' financial systems are expanding, making the task of ensuring safety of our systems more critical. International obligations and the interregulatory consensus built via United Nations resolutions, Basel Committee on Banking Supervision, and the Financial Action Task Force also require that we put in place an elaborate KYC framework in India. The Financial Action Task Force is an intergovernmental body established in the year 1989 as a G7 initiative. Its tasks are to set the standards and promote effective implementation of legal, regulatory, and operational measures for combating money laundering, terrorist financing, and other related threats to the integrity of the international financial system. It is a policy-making body which works to generate the necessary political will to bring about national legislative and regulatory changes and reforms in these areas. It monitors the progress of its members in implementing necessary measures. There are 36 full-fledged members of the FATF. India is one of them. Over 18 jurisdictions around the world have committed to the FATF recommendations. India has also committed to implement the recommendations of FATF. Originally, in 1990, FATF had 40 recommendations focusing on drug money. It revised its recommendations in 1996 and broadened the scope. In 2001, it further added 8 special recommendations, later on added one more, to combat financing of terrorism, which were further revised in 2003. The latest exercise in 2012 combined these 40 plus 9 into 40.